Hey traders, Nick here. Wanted to cover a mini lesson, but it actually applies to something. Okay, so Snap reports earnings this week. So the idea was, if somebody wants to bet on a call, meaning if somebody wants to bet it's going to rise, then I'm going to share how to do that several ways. Mind you, I don't know if it's going to rise or not. Nobody does. Like we said, earnings are a complete coin flip for the short term, okay? However, it is, my guess is as good as anybody else's. But I can tell you what's in the tea leaves here. Okay, so the options market, this is this week's contract. Okay, this week's contract, 3 days on the clock. And they're pricing in about $2.30 move in either direction. So they don't know which way. So it could either be $2.30 lower or $2.30 higher. The implied volatility, what is that? That is how nervous they are. Okay, they as in the traders. Like the VIX is the implied volatility basically for the whole market. Each stock has its own implied volatility. It's a lot higher now than out in time. This shows you how it usually is, and this shows you how it is right now. See, the further out in time, the implied volatility is about the same. For this week, it's elevated. Next week, a little bit more than normal. So that's why selling options here makes sense, because they're juicier. Like usually that 31 cents would be like 10 if there was a normal week. But because of the earning, it's 31. I'm estimating on the 10 part, but you get the idea. So this week they're expecting about a $2.30 move. So how do I play this if I wanted to bet long? So usually I buy calls, but $1,000 for 10 contracts is a lot of money. If I wanted to buy this one, I can go up and make it cheaper, but that's a lot of money to throw on a lotto. 40 cents a contract. I can minimize that expense by doing debit call spread. What does that mean? I buy this one, I sell that one. This way I give myself, I'm going to have to pay about 22 cents or so, 20 cents, 22 cents, depends on the market when you exercise it. And I have a chance to double my money if it rises. I can do it out here and it costs me 10 cents to do the same spread, but I have a smaller chance of success. So if I wanted to do a at the money spread, I usually like to go 1 week out or two, because it's going to cost the same to do it this week or that week or this week or this week if it's near the money. If I go up to here, it's different price for weeks out. It gets more expensive. So this week is cheaper. So either buy calls, buy the stock, obviously, but I don't want to ring $15 to buy it, or buy a debit call spread. It could be 50 cent wide, meaning this one and that one, or this one and that one for $1 wide. So a little bit more upfront for a little bit more money to make out in the back. Or I can get fancy, and that's what we're going to talk about today. Fancy is doing like a calendar. In this case, I want to play with time. I started this by saying implied volatility is high here. So what if I sell it to capture some money in order to put my money to work? So selling it here is crazy, because that means I'm shorting the stock. I don't ever do that, never. But what if I wanted to get long, say December 8th? Okay, and I'm going to take this out. So if I wanted to do my lottery ticket in December 8th, and if I wanted to go to 18, so I pay 54 cents for the calls out here. So if I do 10 contracts, by the way, the 10 number is just a random number. I'm just using it for a round figure. This is different for people. This is a lottery ticket for the short term. So if I buy this contract, 18, I spend 54 cents. So if I do 10, that's $550. But the implied volatility is normal. Okay, normal. So get that out of there. So I'm not overpaying because of earnings. Maybe just a smidge. That's it. Okay. So what if I put this week's to work? These will expire in 3 days. And if I go to 18, it's 30 cents. That's usually like 10. So there's juice there. So if I sell these against them, I'm not creating an extra risk, meaning I'm going to spend the difference. So $240, 24 cents per contract. On 10 contracts is $240. That's the difference out of pocket. So there, I'm hoping that Snap rallies to 18, but not higher, and then goes higher next week. Why? Because that 30 cents will expire worthless. So I would have given myself a discount of 30 cents to buy the calls here, the 54 cents. Does that make sense? So now I would have a call calendar. Calendar because I'm playing with two different timelines. One here, I sell that one. Very important, sell the short one time-wise, buy the long one. Otherwise, you're creating undue risk. Okay, so initially I wanted to buy this one. That's how it started. I wanted to buy this one. So I'm seeing, okay, how can I lower my entry price? Okay, I sell this one against it. Okay, so now I'm going to even tip the odds in my favor a little bit more. I'm going to sell higher. So I can sell either the $19 call instead of this one. Collect less, but I'm guaranteed. What if Snap goes to $1 million tomorrow? You know, exaggeration. What if it goes to 22? The other setup would leave me in a pickle. I'm not making money. I'm losing a little bit. So this one will guarantee me some money because even if it goes to 22 and they exercise this on me, what does that mean? It means that I'm short at 19, but no worries because I'm long at 18. So there's a credit. You know, I made money there. So that's why I prefer the calendar to be called a diagonal, meaning not the same level. If it was the same level, 18 and 18, they're flat, right? But if I do 19 and 18, it's a diagonal. It's no longer a flat line between the two contracts. It's a diagonal. Capiche? Okay, so that's the idea of a diagonal. To recap, if I want to bet long on Snap, underscore bet. Okay, bet. This is a bet. Because I don't think the fundamentals are that great. I'm just thinking price action. And the market thinks it's going to go up. So I bet long if I wanted to. I would buy this contract for $500 on 10 contracts, or one for 50 cents. Okay, so for times 100. So it depends on the size of the bet. I buy this one for 52, 53, 55 cent contract. Okay, to lower my entry point into my bet, I have the option of selling something short dated that is juiced. Like this should be a lot lower, so I can sell this against it and collect some money. It looks maybe Snap just dropped a little bit because the premiums are dropping, or sell the 19 against it. Okay, so instead of 55, I'm collecting some here, 17. So now the 55 is a minus out of my account. The 17 is a plus into my account. The end result, I would end up doing a call diagonal, buying it. It's an expense out of my pocket. If you see the order as a credit, it means I did it backwards because I want to sell the near dated one and buy the far dated one. I'm selling the 10th, which expires in 3 days. I'm buying the longer dated one. I could have done this one, which is even cheaper. Okay, so we were talking not by much. So that's why, you know, I don't care. A week in, week out. I could do next week. That'll be even the cheapest. But next week it still has juice. Remember I showed you that? Extra juice. So maybe 2 weeks out, the 24th. That probably the cheapest. By not by much. So that's why I picked this one. Seemed like eyeball. Yeah, I could have gone December. So I buy the December. What is it? 1863. So we're extra 10 cents here. No, there's a big difference. So it seems like the sweet spot is December 8th. Just hypothetically speaking here. This one. 18. If I buy this one, mind you, I could have done here and then go lower over there. But I want to give it room to spike this week, but not reach my leg sold. Because if it doesn't, those premiums will collapse and the 17 cents will turn into 5 or 0, expire worthless ideally, leaving me long. So if this week Snap moves up but doesn't breach my 18.5 or whatever, 19 that I sell, this one, then that means that this one that I bought, it really cost me 52, 53 minus 17 because I collected that and expired worthless. Somebody bought that from me and they lost their money. I sold somebody a lottery ticket. I wouldn't do that alone. I stress that. I would not do that alone because that means you're short Snap at that price. So if Snap goes to 25, you already lost $6 per contract plus minus what you collected for this one. So $6 per contract. That's a lot of money. So I would not sell calls, period. I have sold puts before where you think there's value. If you don't mind owning Snap at 12, I sell that, collect 14 cents a contract. So if I sell 10 contracts today and Snap stays above 12 by Friday, that $140 is mine. Worst case scenario, Snap falls to 11, and then I own it at 12. So I lost $1 per contract. But if I think that Snap is a deal at 12, I don't mind doing this. I don't. I'm just saying if I did. So everything I said about calls works for puts. What does that mean? It means if I want to short the stock, I can buy a put in December 8 and sell a put against it here. So I would buy a 12.5 or $13 put. I spent 60 cents for it. That's a lot of money. But what did we say? Shoot. Okay, 13. But I can sell this week's 13 or 12.5 against it and collect, 15 cents or 20 cents or 30 cents, depends on where I want to do it. If I sell the 13, it's a, what is it called? A put calendar. Same level, 13 and 13. But if I buy the 13 and I sell 12.5 or 12, that's a put diagonal. Debit out of my pocket. Okay, don't miss it. Always, I'm selling the near dated one, buying the longer dated one. Otherwise, I'm creating risk. All right, Nick signing out. Let me know if you have any questions.